Welcome to the Paper Trail, where we follow the journey, my journey, through the world of a CEO of a mortgage note fund. I'm Chris Seveney, and after years of buying, managing, and selling notes with Seveney Investments, I'm here to share the real stories behind the deals. What went right, what went wrong, and what I wish I knew earlier. From non-performing loans to seller financing to private lending, this show is about more than strategies, about growing your business, learning to follow the paper trail, and doing the due diligence that separates the pros from the rest. Now, let's hit the trail running. Welcome back to the Paper Trail. I am your host, Chris Seveney, and today we are talking about the double squeeze that is hitting real estate construction right now from two very different directions simultaneously. We can talk tariffs on building materials and shrinking construction labor pool. So we're going to talk about those two. Before we dive deep, this is a topic I am very passionate about as somebody who has spent nearly 30 years in construction, development, building, the entire landscape environment. This is where I've spent the majority of my adult life. I've seen the different market cycles. I've seen how the economy is being hit by different things. I've seen how it's impacted over time. So this is an avenue that I like to say, yeah, I kind of got experience on this and know what I'm talking about. So as we roll into this episode, this is one that I will be a little bit more passionate about because not only do we run a note fund that owns real estate and we're doing some renovations and so forth, I know a lot of people in the space. Now, before we go any further, say something very clear. This episode is not about politics. We are not going to debate any type of policy or trade. What we're going to do is follow the money. We're going to look at what's happening on the ground in real estate, in construction, what it means for supply, what it means for collateral values, and what it means for you as a passive investor. So let's dive into it. First, I want to dive into the tariff squeeze on materials. I want to start with tariffs because that has been one of the dominating financial headlines this year. As of March, estimated average tariff rate on all imports is 12%. Now, while that number might sound abstract, until you start applying it to what actually gets into real estate, steel, aluminum, lumber, copper, HVAC components, roofing materials, everything that goes into a property or building, multifamily, single family, either crosses a border or gets priced off of what commodities that do cross the border. And when you add 12% on top of supply chains that are already stressed from the prior years, construction budgets can get hit hard and fast. JP Morgan, their real estate team, put something out recently that I thought put it pretty simplistic and plain. Tariffs and associated policies and the uncertainty that has increased construction costs and has delayed both new investment decisions and continuing forward on others. And it's just not the cost. It's that uncertainty. Developers can't underwrite a project when they don't know what the materials will cost 6 months from now. The practical effect of this, new construction starts are slowing. Developers who are on the fence about starting a project are staying on the fence, and projects that were barely penciling at 6% construction budget are now completely underwater. And that has downstream effect on supply. Also has impact on passive investors that need to understand. And again, I'll reiterate, developers cannot underwrite a project when they do not know what the materials are going to cost 6 months from now. That uncertainty is not just inconvenient, it is a deal killer. And when developers stop building, supply stops growing. Now let's talk about the labor squeeze, which is the other side of the equation and one that is less covered in the press, but we're hearing it directly from borrowers, developers, contractors in our own portfolio. Construction labor pool is tightening. Costs are going up and timelines are getting longer. We've got a project in Texas that it's nearly impossible to find contractors, drywallers, painters, people install cabinets. I literally can't find anybody. And we had a price recently on a property. Get this, to paint this property, the inside of this property, $200,000. It's a joke. I can't find anybody. That's my cost. Now, let's add some more context. Construction in the US has historically relied heavily on a workforce that includes foreign-born workers. That workforce has been a critical piece of how the industry has been able to scale up and deal with the demand. When housing starts surge, the industry needs to staff up quickly. That labor flexibility has been a structural feature of construction economics for decades. What we're seeing now is the labor pool is contracting. Whatever your view is on policy, the on-the-ground reality is contractors are telling us it's harder to find skilled tradespeople. Framers, roofers, electrician, masons, concrete workers, they can't find people. And timelines are extending because you can't move as fast when you're shorthanded. When timelines get extended, carrying costs go up. And when carrying costs go up on a construction loan, developers' margins, what happens? Gets compressed further and further. Now, I want to be specific about what we mean by harder to find labor. We're not talking about a mild inconvenience. Contractors used to be able to staff a project in a week are now telling us, I need 3 to 4. Bench depth for subcontractors, which are people they can go pick to finish other projects, is getting very thin. And when you combine that with material cost increases, a project that looked viable 6 months ago may no longer work financially. Or what you thought it would cost to finish off the renovate property to get it to its market value is costing a lot more. And of course, again, taking significantly longer to get completed. And we are hearing this directly from contractors and operators. They are all saying skilled construction labor is harder and more expensive than it was several years ago. Again, this is not any type of political statement. It's ground level reality that affects every development pro forma in this country right now. So, taking those two topics, the double squeeze is what I call it, is in action. When you put those two forces together, the compounding effect is what makes this story so important for real estate investors and passive investors who invest in real estate to understand. You have tariffs pushing up material costs. You have labor supply tightening, which is pushing up labor costs. And both of these hitting simultaneously on the same construction budget. And when they hit at the same time, when interest rates are no longer 3 or 4%, construction loan financing is more expensive. Also, taxes are more expensive. Insurance is more expensive. Developers are already dealing with tighter lending underwriting guidelines and standards. This makes it harder. So what does all this produce? Produces that sharp pullback in construction starts, fewer units coming to market, fewer commercial being delivered. And it's a direct impact on collateral backing existing real estate loans. Here's the simplest way to explain it. When new supply is constrained, existing assets become more valuable. If you own or you are lending against a stabilized property in a market where new construction is slowing, competitive pressure on that asset just increased. Tenants have fewer alternatives. Rent growth become more sustainable. And collateral values hold up better in a stress scenario. Now let's look at that in simplistic terms. I live in the Washington, D.C. area, Northern Virginia. You are seeing very limited new construction, new supply being added, because this area has pretty much already been developed. So what has happened over the last few years? I don't believe home prices shot up like they did in other parts of the country. They, of course, did rise, but we haven't seen any fall off. You can talk DC and condos and a few, or I'm talking single family homes, have been pretty resilient. Now, I just came back from Florida and I was in Port Charlotte, Cape Coral, kind of that South Tampa area. New construction was going well. Now it's slowing dramatically and slow to the point of there's a lot of unfinished properties and there's still an oversupply in that area. So that is now bringing values down. But this is also one of the reasons why we are bullish on note investing right now. This double squeeze on costs is strengthening some collateral for our existing assets in great locations. These assets are not facing some supply competition they normally face in construction environment, which is why they say in location, in real estate, location, location, location. So as we talk about this, we like to try and provide a lot of education for our passive investors. So how does this information be helpful to people who are passive? First, ask about supply in any market where you're deploying capital. How many units, how much square footage are currently under construction or permitted? What type of projects are actually getting built? If you are investing in multifamily, I spent many years in that. One of the things we would always do when we were building or developing is have John Burns provide a feasibility study. What's the average cost per square foot, net rent per square foot? What's the average cost to build per square foot? How many building permits are out there? How many new projects are getting built? How many new properties are coming on? How many people are coming to that area? That's all very important information because you want to know what the absorption is. If you're building a 300 unit apartment building, they're not going to fill 300 in one day. Are they 10, 20 units a month? What is the absorption? And is the absorption with giving, I can't think of the name right now, but giving like a month free, concessions? What are the concessions involved in all of this? I've been on projects where they anticipated 20 units a month and it ended up being 12. What happened? You didn't get the stabilization till much later deadline, which gets that permanent financing. Temporary financing, a lot more expensive than permanent financing. Now, fortunately, the people I was working with at the time had oodles and oodles of money that they could easily put additional capital into these deals to accept that absorption. But in a multifamily syndication, that's typically not the case. So that's when you see the capital calls or other things where they're getting the money. A lot of times, property might get built for the right number, but they miss on that absorption. So it's important not only to understand that component, but make sure that person developing that property gets some type of third-party feasibility study, because anybody can put numbers on a napkin and send it off to somebody and say, here you go. So I just wanted to share that with you because you want to know, is the market oversupplied, undersupplied? And also track it over time, because what happened a year ago could have very different outcomes today, because sometimes projects might get shelved. Now, second, as in a passive investor, you need to understand how construction cost pressures affect the equity story in any fund or investment you're evaluating. If it's a value-added new development, they need to have very conservative construction budgets with meaningful contingency built in. To me, 10% contingency is not enough in this current environment. Ask what their assumptions are. Then, which we beat this like the dead horse, is think about where you sit in that capital stack. Construction cost overruns hit equity first. So if you're the debt behind maybe a senior lien, you have some cushion before the real impact of the project overruns those budgets. If you're in equity position in a construction deal, sorry, you're the first to absorb those overruns. So make sure you know where you sit in the capital stack. Again, I want to reiterate, construction cost overruns hit equity first, always. If you're in a senior debt position on a construction deal, you have a buffer. If you're equity, you're absorbing every dollar of cost overrun before the lender feels anything. I also want to reiterate, this double squeeze on construction cost is actually strengthening the collateral for some existing assets. Less new supply means properties that already exist face less competition. That is a tailwind for anyone who's lending against stabilized real estate right now. As we look to wrap up this episode, again, these two forces hitting construction simultaneously. Talking tariffs on materials and the tightening labor market, which is leading to higher costs, longer timelines, fewer projects getting started, and less new supply coming to the market. For equity-heavy construction deals, this is serious risk. If you're a debt investor, when you're securing against existing stabilized assets, it's a supporting factor of those collateral values. So understand, again, what you're investing in. This is why I think it's one of the best times to invest in note funds. So I want to thank you for watching this episode. On the next episode, we're going to look a little bit more into the capital flow story happening right now in private credit, as many institutional and individual investors are rotating out of private credit and looking at real estate as a place to put their money. We're going to break down what the rotation means, who benefits, and how to evaluate a real estate note fund in this environment. So thanks for listening to Paper Trail. Hope you can subscribe on your favorite platform and share this episode with a friend, advisor, investor, or anyone who's interested in learning more about real estate. Until next time, thank you. Thanks for joining me on this episode of The Paper Trail. I hope today's insights help you sharpen your note investing strategies. If you found value in this conversation, subscribe, leave a review, and share it with fellow investors. I'm Chris Seveney, reminding you to keep doing the work, trust the process, and always follow the paper trail. Until next time.